All right. In um, this lecture, I just want to go over with you guys how the simulation that we did or the game that we did in class relates to the 1920s stock market crash and how that's going to lead into the Great Depression. So something I kind of want you to think about, and some of my classes thought about this at the end of the game, but when we started the game, the stock market game, what prompted you at the beginning to buy stocks? And so for most people, it was that after that first round, you saw those stock prices increase and everyone gained money that first round. And that gave people confidence that the next rounds were that was going to do the same. Now, I heard some people discussing like they understood that there was risk every round. They didn't know what was going to happen to their money, but they had confidence enough to put most groups putting all of their money into the stock market each round, even though it was very clear that you didn't have to put all of your money into the into the stock market. You could have only put $100 into the stock market and then just kept that $100. But as you start making more money, it's going to grow your confidence. And inherently, people like to kind of be a little bit greedy and try to get as much as they can. So that encouraged people to continue buying stocks in this game. Most people chose to invest all of their money. A few groups, and typically those were the winning groups, reserved money and didn't put it in the stock market. And those people ended up on top at the end of the game. And it says, why does your group continue to buy stocks before the crash? Most groups, again, like I said, had confidence after they kept seeing those numbers go up on the share prices that the stocks were going to continue to increase. So that gave people confidence in buying more. But then the stock market crashed and groups continued to invest. At that point, perhaps they had nothing else to lose, or they thought that the stock market was going to rebound. And the stock market, since this is simulating the 1929 stock market, the stock market did not rebound, and it did not rebound for quite some time. But that was the mindset of the people in the 1920s. They just thought, oh, I'm going to continue to invest. It's just going to drop a little bit, but the stock prices will return. So even when the stock market initially crashed, people still tried to put money in, and then they just kept losing money. So the stock market crash is also known as Black Tuesday, October 29th, 1929. This is the day that many stock prices plunged and a lot of the stocks lost their value. And the main cause of this was right before this, a lot of people started to want to sell their shares, and not a lot of people were trying to buy shares. And something to point out, the stock market crash is a cause to the Great Depression. However, it is not the only cause. So we'll talk about a few other causes to the Great Depression as well. So what we experienced at the beginning of the simulation, or the game we played in class, is known as a bull market. A bull market is the steady rise in prices over a long period of time. So prior to the years of the Great Depression, or prior to 1929, a bull market existed in the United States. So people, just like we did in our class, people saw over time that those prices were continually going up, and you have more and more people wanting to invest. You have really high confidence in the stock market. And this is kind of at the inception of the stock market, and people thought that there was no limit to how high the prices could rise. So something known as like high confidence, it's also called high speculation. So at this time in the 1920s, there was a lot of optimism, people feeling good, and a lot of high speculation by American consumers. And that confidence, again, it's going to lead them to buy more stocks. Like I said previously, they thought there was no limit to how high the stock market could climb. And then people started to buy as many as they could afford, and they started to do something called buying on a margin. And buying on a margin is what really caused a lot of people to not only lose their money in the stock market, but lose savings accounts, lose houses and property as well. So what is buying on a margin? Buying on a margin is when a person only pays for a small amount of the stock, it's usually around 10%, and they borrow the rest. It's being lended to them from their broker, the person who sells the stock. So you could be a person with $1,000, and you can borrow $9,000 and you can buy $10,000 worth of shares. Now, initially, maybe for some people, this would work out because their hope is that they profit so much on these stocks that they have enough to pay back their stockbroker and they have enough to profit for themselves. So the more, as you know from our first simulation we did, the chart, the more shares you have of a stock, the greater your profits are going to increase. But some people didn't have a lot of money to buy stocks with, but they still wanted to participate in that growth of wealth that others were experiencing. So the decline begins, and it doesn't just suddenly happen on the 29th. When the market began to decline in the summer of 1929, creditors, and those are people who loaned money to people buying stocks, they demand to be repaid. So they start to sell off their shares in the summer, and a lot of people couldn't make enough money on those shares to repay what they owed to their brokers. So then people had to start selling their houses and their belongings in order to repay their debts. Businesses who had invested lost their money. So not only can you have a single investor in the stock market, but if I own my own business, I can use my business account to also invest in the stock market, and that money would go to help my business. But businesses who had invested at this time, they lost all their money and that business had to shut down. And then they entered into a period called a bear market. A bear market is a market in which prices decrease at a steady rate over an extended period of time. So even after the market crashed, people had really high hopes of the market getting better, and so they continued to invest, just like you guys did after the stock market initially crashed in our game. People still put their money back into the game. But as these prices continued to drop, sometimes it would be in really small increments, sometimes it'd be in large increments, and people just kept losing money. So the other causes of the Great Depression that were also happening at the same time was overproduction. We had been able to produce mass quantities of goods, but stores produced too much and there weren't enough buyers to buy all the goods. And that goes hand in hand with a term called underconsumption, people not buying enough of what is being produced. This led to farms going bankrupt. This led to businesses going bankrupt. So not only individuals, but businesses and farms as well. So the government has to respond to this, and so they do so in a couple ways. They start to tighten the money supply. They decreased the amount of money in circulation, and that leads to inflation or a rise in prices. So when there's less money available, things typically are higher in price. Just like if you have a limited edition pair of shoes that comes on the market, that price is going to be inflated because there's not very many of them. Okay, the more, if you have shoes that have millions and millions being produced, those shoes are typically cheaper. Okay, that's kind of inflation. And then tariffs on American goods. So American goods being shipped overseas, those increased because the government had increased tariffs on foreign goods. So again, what this basically means is that it costs more money for other countries to buy American goods. So farmers that relied on other countries buying their surplus of crops were no longer able to sell those overseas because it was too much for foreign countries to buy. Okay, and that wraps up this lecture. And so the next thing that you are going to do is you're going to fill out the stock market simulation follow-up that is directly under this assignment in Schoology.